Hello, my name is Patricia Nduku, an investment analyst at Cytonn Investment. So in today's series, we are going to cover fund management, what it entails, and what the investor is supposed to take as factors to consider before you put in your investment. So just to start with, what is fund management? Basically, it entails the fund manager pulling funds from investors and investing them in allocated investments depending on the research and the decision of the fund manager. The first one definitely is you're benefiting from the expertise of the fund manager because they're experienced, they're professionals in this field. So they're best placed to make the investment decision for you, and in that you're more likely or rather assured of better returns than when you're doing it for your own. The other benefit is, of course, diversification. And under this, as an investor, you're guaranteed of the benefit of returns from several asset classes. So as a professional fund manager, you're going to put in the money in different asset classes. So under this, it comes out as a benefit in case one of the asset classes faces maybe volatility and negative volatility in the market. So you are able to get positive returns in the other asset classes. Funds that are available in Kenya, we have the unit trust funds, we have mutual funds, we have pension funds, we also have the hedge funds, which are not very common among simple investors. So just to give a brief introduction of all the funds that we have in Kenya, we have the money market, which basically invests in investments that are at most 12 months. So this one will include the T-bills, that is the 3-month, the 6-month, and the 365-day paper. So on money markets, this is the most common investment, or rather a mutual fund investment among the common investor market. So money markets basically invest in investments that are at most 12 months. So under this, we have the T-bills, the 91-day paper, the 182-day paper, and the 365-day paper. Then we also have commercial papers that are rather private offered by companies. Then we also have the fixed deposits and call deposits by banks. So as you can see, the investments are very liquid. So that's why the fund can offer you liquidity when you need your money. Then you also have the equity funds. As the name goes, these ones invest in equities markets, that is the stock market. So we can say they have a higher risk compared to the money markets, because we all know that the equities market is more volatile compared to the fixed income market, which is a bigger asset class in the money markets. So for the equity funds, they are more for the investors who are looking for a higher return, but they are not very risk averse. They don't fear risk, so they are more open to the risk that is in the market, and so they are willing to get the higher return. Then the other segment, we have the fixed income funds, which basically invest in the bond market. We have the government bonds, and we also have the corporate bonds. So the corporate bonds, of course, they are offered privately by companies. So that's where the fixed income funds invest their money. Then now we have the balanced fund. The balanced fund basically it will just incorporate all the asset classes. The balanced fund will incorporate all the asset classes. We have the equities market and the fixed income market, and that's where they're going to have a moderate risk, because it's a balance of the long term, the short term tenors. Then we have the pension funds, which basically, as we all know, they are for your retirement benefits. We have the ones that will give you a constant return every period as specified by the fund manager. So on this, you're supposed to get a good research for you to get what is most beneficial to you as an investor. Then on the other one, we have the hedge funds, which are more complicated to a simple investor, but basically they'll look to offer a return that is above the market average, and they have a higher risk as compared to the normal funds like the money markets. So on this, the investor is trying to hedge the risk that is associated with a certain asset class by investing in other assets that move differently with the main asset class of the fund. So in that way, in case of anything volatility in the market that affects the one asset class, then the investor will get returns from the other asset class that is the hedge of the fund. Fund management, basically the process starts from the pooling of funds from investors. Then after that, the fund manager will do the research on the available asset classes depending on the risk that is associated with every asset class, and also the strategy of the fund, because as we said, you cannot have the long-term investments in an investment like a money market. So it will also depend on the strategy of the fund. Then after that, now the investor will make the decision on asset allocation, where you'll decide this much will go to probably the bonds, or this much will go to the call deposits and all that. Then now you'll check, since now your portfolio is all set, you've set your portfolio, then now what goes on is the continuous check-in of the portfolio, just to make sure your investments are performing as desired.